Hi, everyone, and welcome to the Money Girl podcast. My name is Laura Adams. I'm a personal finance expert and award-winning author of multiple books, including Money Girl's Smart Moves to Grow Rich. On this show, I help you master your money so you can live rich and love the journey. I cover the nitty-gritty details on how to manage your money for success. My goal each week is to expose you to something new from a variety of financial topics that you need to know, like investing for retirement, building credit, managing debt, insurance, real estate, taxes, and mindset. There's a huge podcast archive on all of these topics, so I typically suggest previous shows that may be of interest when I think they're still relevant. All of the resources that I mention are in the notes for each show on the Money Girl section at quickanddirtytips.com. This is episode number 472, called Can You Have Multiple Health Savings Accounts? Rules to Know. The beginning of November marks the start of open enrollment for Obamacare health plans. So many people have been asking me about health insurance and how to make it more affordable because, as you know, the cost continues to go up year after year. No matter if you get health insurance through work or on your own, there's an often overlooked way to save money on medical expenses called a health savings account, or HSA for short. I've had an HSA for many, many years, and I love the benefits. But I find that many people who could be taking advantage of these special accounts are not. So I'll explain how they work and who can have one. Plus, I'll answer a listener question about what to do when you end up with more than one HSA, which is something that I've also experienced. So I'll start with a quick primer about health savings accounts. These were created in 2003 to help consumers manage the rising cost of medical care. Money goes into the account before it's taxed, it grows tax deferred, and then can be used to pay for current or future medical expenses tax-free. It's a really amazing benefit. Contributions you make that were previously taxed can be deducted from your taxable income when you file your income tax return. So that's the case even if you don't itemize deductions. That means you never pay tax on money that goes into your HSA, which is a terrific savings. Using an HSA to pay for qualified medical, dental, and vision expenses is just like getting a 20 to 30% discount on those services, depending on your tax rate. That's not bad. Plus, a little-known benefit is that you can also use an HSA to boost your retirement savings. That's because after your 65th birthday, you can take distributions to spend any way you like, even on non-medical expenses. You contribute money to an HSA and then spend it on a wide range of qualified, unreimbursed medical expenses until your deductible is met on your insurance. Or these could be expenses that are not even covered by your health insurance, like copays for doctor visits, dental bills, or getting prescription glasses. But the downside is that if you spend any amount of HSA funds on non-qualified expenses, like groceries or a ski trip, before reaching age 65, you'll owe income tax plus a very steep 20% penalty on those distributions. So you want to make sure that you're only putting money in for your anticipated medical expenses and that you're not putting money in that you could need to take out early. What's really great about an HSA is that you own it. You own it as an individual and you control it completely, even when you get your health plan through an employer. You don't need permission from an employer or the IRS to set up an HSA, and it stays with you even if you change jobs or become unemployed. There's never a deadline to spend your HSA money. Funds can stay in the account indefinitely until you want to use them, even if you change your insurance company, become uninsured, or are unemployed. There's no maximum account balance limitation or any maximum income limits you have to meet to be eligible to contribute. The rules are pretty easy. You generally can use the funds for qualified medical expenses for you, your spouse, and dependents that you claim on your tax return. If you're interested in learning a little bit more about HSAs, I did a previous podcast, which is show number 391, called How to Save Money on Healthcare with an HSA. So let's talk about exactly how much you can put into a health savings account. The IRS sets limits each year on the total amount you can contribute. And there's also what's called a catch-up policy that allows you to contribute an additional $1,000 when you're age 55 or older. And that's the case with either an individual health plan or a family policy. Here are the maximum HSA contribution limits for 2016. If you have an individual plan, so that's a plan where you're just covered, you can contribute up to $3,350 or up to $4,350 if you're 55 or older. Now, if you have a family plan, which is you and someone else, so you and a spouse or you and a dependent, you can put more in each year. For 2016, you can put up to $6,750 or $7,750 if you're 55 or older. Now, in 2017, the contribution limit goes up slightly for individual plans. It goes up to $3,400. That's just a $50 increase. But there's no change for family plans. All of these HSA benefits sound great, right? Well, in order to qualify, there's a catch. And before I explain, I have a quick word from our sponsor, Zoho. Most businesses have three focuses: to acquire and serve customers, to empower employees to get their work done, and to manage internal processes to support customers and employees. Zoho handles all of these and more. An important first business moment for me was hiring my first employee and dealing with all the accounting that goes along with that. Zoho has a set of marketing, sales, and customer support applications, which allows the business to acquire and serve customers. Zoho's powerful productivity applications like Mail, an Office Suite, and online collaboration tools help empower employees to gain customers for the business, while human resources, finance, accounting, and expense management applications keep everything ticking. Visit Zoho.com to learn more and create your free account, and tweet at Zoho using hashtag #ThatFirstMoment to share your most inspiring first moment. Zoho, there's a first time for everything. Okay, I mentioned that there's a catch to being able to use a health savings account. Here's the deal. You must first be enrolled in a high-deductible health plan. These plans are just like regular health insurance policies, except that they have higher deductibles. That means you have to pay more out of pocket before your benefits begin. Insurance deductibles and premiums always work like a seesaw. The higher your deductible, the lower your premium. Because you're responsible for more of your medical expenses, a high deductible plan typically costs less than a regular plan, so they're a great way to save money. For 2016 and 2017, a policy deductible must be at least $1,300 for an individual plan or $2,600 for a family plan in order to be considered a high deductible health plan and make you eligible for an HSA. Now, if you qualify for an HSA because you have one of these plans, you may be thinking, well, where do I get one of these accounts? It's really easy to open them up. They're available at many banks, credit unions, brokerages, and specialty institutions like HSAbank.com. Most of these accounts are really convenient to use. They operate just like a checking account, and they offer paper checks, a debit card, and online banking. You can make contributions to an HSA at any time, even up to April 15th for the previous tax year. But you're never required to make any contributions to an HSA. And there's actually a really unique way to fund your HSA for the first time using money you've already saved in a traditional IRA. Here's how it works. You can do a tax-free rollover from your IRA into an HSA once in your lifetime, up to the annual contribution limit. So what happens is the trustee of your IRA simply transfers the funds to the trustee of your new HSA. And that's how I opened my first HSA many, many years ago. Contributions to an HSA can come from you, from someone else, or even from an employer. Some company benefits include regular deposits into an HSA, like $150 a quarter. It's similar to workplace matching funds for a 401k or a 403b retirement plan because they're not included in your taxable income. However, unlike a 401k where employer matching allows you to exceed the annual limit, that's not the case with an HSA. The amount you, another person, or your company contributes can never exceed the limits I previously mentioned. So you have to monitor it throughout the year to make sure you don't go over that annual limit. And while I'm thinking about it, another great podcast that may be of interest on this topic is called 7 Ways to Save on Healthcare and Fitness. That was episode number 413. I received a great question about how to manage multiple health savings accounts from a member of my Dominate Your Dollars Facebook group named Abiku. He says, "How many HSAs can I have? I just got a new job that will match contributions if I sign up with their HSA provider, but I already have one for my previous job. Would it be a good idea to keep the older HSA for long-term investment purposes?" Okay, back to Abiku's question about having multiple health savings accounts. Abiku, thanks so much for sending that in. You can have as many health savings accounts as you like. However, you can't exceed the annual contribution limits that I mentioned. This has happened to me and my husband a couple of times throughout the years because many companies offer high deductible health plans and a recommended or preferred HSA. So if you're like me and you don't really want the hassle of having more than one, here's what you need to do. First, compare the fees and options of both accounts to understand which one costs less and gives you more flexibility. If you decide that you only want the new HSA, here are your options. Number 1, you can open the new HSA, then spend down your old account to zero and just close it. Your second option is to open the new HSA and roll over funds from your old account into the new one and then close the old account. But let's say you don't want a new HSA, but you're eligible for employer contributions and you don't want to miss out on those. You want to ask the payroll or benefits department if you can have your deposits sent to your current institution. This should be easy to do. However, you may get some resistance because it does take a little extra administrative work. If your employer insists that you open an HSA with their recommended institution in order to qualify for employer contributions, I want you to go ahead and comply so you don't miss out on the free money. If you feel strongly that you want your contributions to end up in your existing account, there's still a way to do it. You can move money from an employer-preferred HSA into your own in one of 2 ways. The first is to do a rollover, where the funds are sent from the HSA custodian to you. Then you send the money to another account custodian. So you would send it to the HSA that you want to keep, the older one. As long as the transaction is completed within 60 days, you don't trigger any taxes or a penalty. But you can only do an HSA rollover once a year. Another option that is not limited in frequency is to complete a trustee-to-trustee transfer. So what happens with this is one custodian sends the funds directly to another custodian. So the custodian of your new HSA would send the money to the custodian of your older HSA. You can do this as often as you like with no taxes or penalty. However, you may be charged a transfer fee, so find out what the cost would be. Once you have money in an HSA, it's important to understand how you can spend it without breaking the rules. The IRS says that for an expense to be qualified, it must pay for healthcare services, equipment, or medications. There's a really long list of qualified expenses that I want you to check out. It's in IRS Publication 502 called Medical and Dental Expenses. I'll have a link for this in the show notes. I want you to check it out because there are some expenses that you might not expect, such as acupuncture, chiropractic, drug addiction therapy, and capital expenses for home improvements related to medical issues. You do need a prescription to buy drugs with HSA funds, except for insulin. That's the only exception. So if you can get a prescription for drugs that are also available over the counter, such as Allegra if you have allergies, you can also buy them using tax-free HSA money. And you can also reimburse yourself for past medical expenses if they occurred after your HSA was established. It's a good idea to save all your prescriptions and receipts as a backup for your taxes. In general, you cannot use HSA funds to pay for your health insurance premiums unless you're unemployed, you're over age 65, or you have a long-term care policy. If you're eligible for an HSA, it's a terrific and easy way to cut your taxes and save money on a variety of healthcare expenses. It can also give you a lot of peace of mind when you have unexpected medical bills to know that you've got savings to pay for them. To close out the show, I'm going to review 7 major benefits of an HSA. Number 1 is that contributions are tax deductible up to the annual legal limit. That means you reduce your taxable income and the amount of tax you have to pay by funding the account. Number 2, you never lose funds because they stay in the account from year to year for your entire life with no penalty if you don't spend them. Number 3, withdrawals are never taxed as long as you spend them on qualified medical expenses. Number 4, contributions grow tax-free when you have interest earnings or investment gains in the account, as long as you spend them on qualified medical expenses now or in retirement. Number 5, you can spend the funds on you, your family, or your dependents when there are qualified, unreimbursed medical expenses. Number 6, you own it and can decide how much to save or spend each year. An HSA is portable, so if you change employers, switch health plans, or become unemployed, it's still yours to keep. And number 7, if you no longer have a high-deductible health plan, you can't continue making contributions. However, you can continue to spend the funds in an HSA on qualified expenses. Even though these are great benefits, remember that a high-deductible health plan isn't the right choice for everyone. They work best when you're in relatively good health and are not likely to spend the full deductible each year. If you can afford paying the higher deductible, having an HSA can help you build up savings to pay medical bills or to accumulate an additional nest egg to spend after age 65, especially if you're already maxing out a retirement account. If you have a money question, please send it in. I try to answer as many questions as I can that I think will help as many readers and listeners as possible. A good place to discuss a question or a money dilemma and get some help is inside my private Facebook group called Dominate Your Dollars. To request your invitation, visit Dominate Your Dollars on Facebook or send me a text message for immediate access. Just text the word dollars, DOLLARS, to the number 33444. I hope to see you in the group. That's all for now. I'll talk to you next week, courtesy of Money Girl, your guide to a richer life.